Hello, Operation Surge Strike. We're back. The room is open and welcome. I'm glad you guys are hanging out with us right now because we have Michael Wade. He's going to be spending the next 60 minutes with all of you, telling you all of his knowledge, diverging it all. Let's bring him in 5, 4, 3, 2.
All right, welcome everybody to Operation Surge Strike, where you get to look behind the curtains of what we look at when we put up these trades for y'all. And guess what? The texting is working today. Hi, Tom. Hi, everybody. Hi, Trader Kathy. Did it again. Did what again, Kathy? Hopefully made money again. Well, welcome, everybody. Today, I don't have any new trades. I'm going to talk to you about what's going on in the markets because they're really volatile, and I'm going to go just sort of dissect what's up. What's going on, what's coming up for the week. I do have a trade for later in the week on a company you probably heard of. It's called Nike. I like their products. And if you have any questions or comments, now is the time. This is your access to the behind the scenes of Surge Strike. I'm going to share with you stuff I look at. The whole idea here is that we educate you around the nuances of options trading. I've been trading them since 98 full time. I quit my job May 28th, 1998. I even know the date. And where I quit, and I've been trading since. And it's been a very rich road of successes and breakdowns and learning and making money and losing money. And, we're doing really well with Operation Surge Strike. I'm going to cover that as well. We took off a losing trade last week and all this volatility. We'll cover that. We do have a winning trade on United States oil that we'll look at here as well. That one looks destined for success. So things are rolling well. And Kathy said, "Yes, you named it. I did it." Yeah, I know the experience, Kathy. I would say I've been trading for a long time, but I've been teaching since 2002. And I think what makes a good teacher is one that's made the mistakes. I've made them all, Kathy. I don't know if you have, but I think I've made them all. And for that reason, I think, I know how to avoid the mistakes I made as a trader, and I bring that to you today, and very happy to share anything. I'll even talk about my biggest losses. Those are my favorite topics, actually. And it's weird. In trading, I don't remember my big wins, but I remember my big losses over time. And that's just sort of the nature of humanity, of being a human being, I suppose, is that, we remember the bad stuff sometimes. So let's get started. Let's talk about what's up. Well, Omicron is in the news, and the news has been all over the map. We had, Omicron came out in South Africa, and the markets corrected. And then Fauci I talked about this last week. Fauci came out and said, well, maybe it's not that bad. We're not seeing that it's going to be that bad. And then yesterday in the UK, an Oxford study said that it's pretty bad, and the UK prepares for a tidal wave of cases. So this has whipsawed the markets up and down. The reason we lost on our diamonds trade was because of this news. We pulled it off last week. Today, that trade would have been in a profit because the bad news brought the markets down. It is like pinball action out there. And to top it off, Omicron is certainly moving the markets big. Today, we got some news that inflation, the PPI, producer price index, rose 9.6% from November, and that's the highest on record. So inflation is definitely a big issue. I was talking about inflation last week, and it raised its ugly head again today with that report. So things are more expensive for producers, and that's ultimately not a good thing for a business. Imagine your costs rose. What would that do to your profits? Now, certainly you can raise the cost of goods or services, but in the balance, the cost of goods is really critical. It could drive earnings down. It will probably drive earnings down going into 2020 if it persists. Now, about 6 months ago, Powell said that it was a transitory situation, but it's gotten worse since. So inflation is an issue. And then to top it all off, the Fed is meeting as we speak. We'll hear an announcement tomorrow about what they're up to. And there's all sorts of speculation. The Fed has been injecting liquidity into the economy by buying bonds, so that props the economy up. And they've been talking about releasing or easing that contribution into the economy, the injection of liquidity into the economy. And I've heard rumors, it's speculated that they may stop it altogether by March. So maybe it seems like they might be easing with greater enthusiasm. So that has been propping the markets up. That may be gone in the course of 3 months. Who knows? And then there's the interest rate decision. We know interest rates are likely to rise in 2020. And that news could be, exacerbated if the Fed says they're going to raise them sooner than later. So all of that is just so many outside forces that are influencing the market. If I was to sum it up in one word, I would say this is the word: volatility. So much volatility in the markets right now. And because and when I mean volatility, I mean that the markets and stocks can gap up and gap down. There's a lot of that going on. And so that makes it very treacherous for us to take on any trade. We tried to get on a Roku trade last week. That was a good setup, but the stock ended up tanking. We couldn't get in. So we sent out that alert last week. And unfortunately, the stock dropped too hard before you were able to get in. So we didn't get into that one. Again, volatility. So let's just take a look at what's up. And then, so today I don't have a new trade. I have one for Thursday, Friday. Decide when to get in here later in the week. But it's just too dangerous. I don't want to put any trades out there that are going to get anybody hurt, So that's what I'm dealing with from this side of the fence. I have your best interests at heart. So does Tom, all of us in Tom's trading room. It's funny, the guys, they're all guys that are doing the teaching right now. We've had females in the past, but the ones that are currently teaching for Tom, all of them are good-hearted humans that are really after being of service to you and to give you great trade. So as much as I want to put out a trade, I have to like slap myself around and not put anything out, especially in this environment. So just going to CNBC.com. This is a good place to go for news. I've got Bloomberg on my screen here, but I like to keep an eye on what's up so I can anticipate where the markets might go next. And here's the big news for today. Wholesale prices, or the PPI, rose 9.6% in November from a year ago. That's the fastest pace ever. So inflation is a big issue. And that's the primary reason that stocks are falling today. And what else we got here? There's some interesting news here, but I pretty much covered it. Fed's meeting. We may get some news tomorrow that could move the markets. So, man, currently the Dow's down 0.41%, the S&P down over a percentage, the Nasdaq's almost down 2%, the Russell's down 1% roughly. So, that's what it is today. 2 days ago, it was up. So, that's what we were dealing with. Let's take a look at some charts here, and let's talk a little bit about what's up in the markets. This is a chart of the SPYs. So if you've never traded the SPYs, it's a stock that tracks right there, the S&P 500 at 1/10. There's also an index that you can trade that also has options. So before I leave this screen, I'll come back to it in a minute. But the SPYs is a stock. So if you wanted to trade the S&P 500, and you were bullish long term, you could buy shares of the S&P 500 by buying a share of the SPYs. The SPYs also have options. We could buy options on the SPYs, calls and puts and spreads, all those things we do with options we can do on this stock. So this is a proxy, if you will, that tracks the S&P 500 at an exceptionally high correlation, close to 100%. Now, if I put up the SPX, now let's look at the chart here, 470. That was a resistance level. Right there, we breached it. I think that was Friday. Yeah, that was Friday. We breached it and closed there to end the week. And then the news came out in England, and then inflation. So that was COVID in England and what's going on there. Dire news. And then today, inflation. So those pieces of news have dropped the markets. Now, what we're going to do between now and Wednesday is probably go sideways to flat. I don't think anybody's going to want to set the market to new highs given the environment between now and tomorrow. Probably 2 o'clock, I believe, is when Powell speaks. That's usually when he speaks. So that's up. Now, if I put up the SPX, back to my original point, if I put up the SPX, this is a cash settled index. It also has options. And you can see it's the same chart. The only difference is that it's 10 times higher. So the S&P 500 is the actual price of the index. And then the SPY is an ETF that tracks that $4,700 resistance level right there at 1/10. So I put up a chart of the SPYs, and you can see there they are, chop off a zero, 1/10. So 470 is resistance here. It's held. We dipped our toe above, it dipped its toe above the water there, and then it has pulled back. So that is the environment. Here, the markets tanked on the initial news out of South Africa about Omicron. And then Fauci came out and said, hey, not so bad. And then Monday, the UK said, well, yeah, it is bad. And the markets started another slide. So that's what's up, everybody. The markets are just crazy. I would say right now, this is not going to be a very useful prognosis, but I'm going to say that the markets will continue channeling, the SPYs will continue channeling between this 470 level. That's an all-time high close right there on Friday, and probably the 50-day average, and maybe even stronger down here at 450. So we're channeling for the time being. Now, one of the other things that we look at when we trade options is implied volatility. And we're going to look at this in a bit. I'm going to do a case study on Nike, our trade for this week. And I want to talk to you about implied volatility. We're going to keep on washing and repeating. There's a lot of moving parts that we look at. And I know when I'm throwing them at you, it might be overwhelming. But I just encourage you to just kind of keep coming back each week. And then in time, with repetition, you'll start to grasp all these concepts. Okay. Let me check the comments real quick here. How are you doing? Okay, Eric said, how are you doing all that chat? How are you all doing chat? Oh, Eric, I'm doing great. Let's see how everybody else is doing. Good to be on board. Thanks, Mitchell. Good to have you here. And then Tom says, yeah, good. Don't push mediocre trades. Heck no. Now, I might do a little bit of that for myself, but I am not going to put out a trade that I don't have a high degree of confidence in. So you're not going to see any mediocre trades out of me or any of Tom's people. Elon Musk is getting ready to start a new company. I've heard rumors of that as well. Tom says again, overall market volume has not been really high, has it? That's correct, Tom. If you take a look at now we had some pretty high volume here when the markets initially dropped based on the Omicron emergence a couple of weeks ago. But yeah, we're in holiday season. We've got a lot of holidays coming up between now and the end of the month, and actually right after New Year's Eve. Volume will be low. Traders are taking breaks. Retail traders aren't trading as actively. So we're not going to have a lot of volume. And that's a reason. That's one of the reasons that I haven't been able to find as many trades. There just isn't enough volume. And everything that we do in Surge Strike is based on an anomaly. It's either an anomaly in volume, meaning volume spikes up, or let me pull up a chart here real quick, or it's something like this, and we'll come back to Nike later, where the implied volatility surges. So we look for surges in implied volatility. We look for surges in volume. And currently, with the holiday season upon us, the volume is light. So that's the end. To top it off, the foundation of the Surge Strike system is these earnings-based trades where the implied volatility rises. So earnings is a catalyst, and we're in December, and there's very few companies announcing earnings in December. Now, that said, mid-January, we're going to have a lot of end-of-year earnings, and we'll get a lot of trades coming right after the New Year starts. So that's coming. So we're in this sort of like this dead zone now of trading. The markets are pretty much quieting, although we've had some big moves based on COVID lately. All right. Tom was looking better. I think it looks great. All right. Okay. So if I go to the diamonds, we had a trade on the diamonds that came off for a loss. We're going to cover this in great detail in just a minute. But the diamonds actually rose. We placed a trade on the diamonds down here, and then good old Fauci came out and propped the markets back up, and we filled the gap. That was not expected, that kind of a rise. We got a gap up. So we've got a similar situation on the diamonds we have super duper strong support right here at 355. By the way, the diamonds is the ETF that tracks the Dow Jones Industrial Average at 1/100th. All right, so this is another what we call exchange traded fund that allows us to get a feel for the market. It also is a stock. You can buy shares, you can short them, you can buy options, you can put any option trade you can imagine on the diamonds as well. So it's a really cool instrument. I like trading credit spreads on these things, particularly in this kind of market. And I'm on the lookout for that. If things start to break down, if we get a close below 355 support, look at that support. Gosh, I love support and resistance. Look at this, 355 right there. And then today, the low of the day is 355.07 right there. That's support. It was support there too. So support and resistance are key. Look at this resistance level at 365. And then we have a support resistance level here at 360. Support, 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 resistance, 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 and now we're back to support. So similar story. If we see if the news starts to get dire, the Fed comes out tomorrow and gives us some news that is considered dire or bad, then I would expect there to be a breakdown below the 50 and perhaps a retest of the 200-day moving average. Okay, so similar story, slightly different chart, but really the same story. All right, let's look at the Qs. This is the NASDAQ 100. It's like the other ETFs, exchange traded funds. You can buy shares of this. You could short shares. You can buy option and put option trades on it. So we're in a similar boat. The Q's strong resistance at 400. I talked about this last week. This is just so beautiful to me. Look, resistance there, support there, resistance, 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 and then resistance failed again, and we're right back down to almost where we started with the Omicron influence on the market. So we're close to it. We're now below the 50-day average. We close there today. I would expect a retest of 380. And all that said, tomorrow we could get a piece of good Omicron news, or the Fed says, "Don't worry, we're not gonna ease as much as we said, and interest rates ain't happening until the end of next year." Something like that. Some positive news. We could see a pop up. So volatility, volatility, volatility. That equals risk. That equals risks. Now, one of the ways that you can trade a volatile market is with these credit spreads. We had one on the diamonds. So it's a way to trade, to inject probability into the trade, even in the face of a volatile market. Now, for example, if I decided that I wanted to buy a put option on anything, based on rules, of course, let's say I get a trade. I have one on Oracle that I'm not taking. Actually, let me show you that right now. Let's take a look at Oracle. Let me talk to you about why I didn't take this trade on Oracle. Well, the main reason is, now let me just go through what's happened. So this came up on the scanners today, and it actually came up on the scanners yesterday and Friday. But today we got a signal to go bearish on Oracle. All right. Now Oracle had great earnings. It shot up to all-time highs. I don't like to go bearish on stocks that have set all-time highs. It's not a good idea. But based on that system I spoke about, I think 2 weeks ago, this is our volume spike system. Look here, massive volume. That was on Friday. Oracle gapped up. They had their earnings announcement after market the next day, which was Friday. It gapped up, set an all-time high. And then look here, we have support at this round number, 100. The low of the day, the open today was at 100. The current price is $99.99 on Oracle. But I got a bearish signal on Oracle today. And I was thinking, well, maybe it is going to drop into and fill this gap. That could happen, but here's why I didn't do it. We've got support at 100. So this stock may very well bounce off support. Why would I want to go bearish on a stock that's at a strong support level? Doesn't make any kind of sense. It just doesn't. And on top of it all, if positive news comes out from anywhere, then we could see Oracle back on its bullish stance and we could have a losing trade. So today is about education around when not to take a trade. I have to say that's more important than taking a trade. So, knowing when not to trade is really important. So the reason I didn't take this signal today was it has found support at 100. that could very well hold. And that's going to prohibit me from all of us, all of you, I don't take the trades, all of you, from making any money if this support level holds. I was looking at a put option. I was looking at a credit spread. So that's the reason I didn't do it primarily. The second is because of the volatile nature of the current markets, it's just risky. It's just risky, more risky to take anything. So that's the rationale there. And then Tom says, Tom, you're really active, Tom. I really want to acknowledge you for being so active. It's really great. Is strong support based on even 100 numbers? Yes. So support and resistance, it's the easiest thing to learn. There's things that we use moving averages. We use indicators like MACD and stochastics and parabolic SAR, and there's 1,000 of them. And then there's Fibonacci that we use. But the simplest to understand is this whole idea of round numbers. And 100 is a round number, of course, and it's an increment of 100. So 100, 200, 300, increments of 100 tend to be strong support and resistance levels. Let me pull up a chart of, let's go back to the SPYs real quick. So you'll notice here that on the vertical axis, we've got 5-point increments. These are round numbers, right? And if you just look at the chart as you go across 470, a round number, an increment of 10, you can see resistance formed, all right? Here, another one at 450. 450, 450, 450. It did get below a little bit there, but that's 450. So, and here's 445. I'm just looking for some other ones. Here you have 440. Here you have 435. So these levels are really important. Right here at 465, look at that, 465, support there, resistance there, support, resistance, support, resistance here. So these round numbers tend to be support and resistance level. If I take a look at Google's down today. Same thing, 3,000, an increment of 1,000. Look at this resistance level there, 3,000. What? Yeah. Look at this support level right here at 2,900. How many times does it bounce off 2,900? Look at that, 2,900. Now we're bouncing off of support at 2,850. So these round numbers on virtually any chart, and particularly charts of stocks that are sponsored by institutions like the S&P 500 stocks, for example, you're going to see these support resistance levels routinely at those levels. Now the question is why? Let me pose that question to all of you all. Why do you suspect that round numbers act as support and resistance? The stock doesn't have any consciousness. The stock's not aware of prices. It's not the stock doing anything. It's humans. So why, and that's a clue, why do you suspect that support and resistance tends to occur at round numbers? What do you think? Peter says algos. Yeah, you're right on track there, Peter. Algorithms that are derived by human beings who think in round numbers. That's how our brains work. And so if you're an institutional trader, you might be bullish on Google, and you say, let's continue to buy this stock until it hits 3,000. And you put that in your algorithm, your computerized trade. They've got trading systems that are computer programs that are buying and selling. So I'm not going to say to my algorithm, buy until Google hits 305.31. I just made that up. I'm going to say 3,000. So God, this is why I love it so much, because it allows us to see over the shoulders of the big money. And we can derive these points. We can derive these targets. We can use them to signal entries and exits into trades. And so I just love it. I thank God it works that way, right? And then Andy says where people put in orders. Yeah, and the people I'm speaking about, Andy, are the actual institutions. Institutions, they control 80% of the market, give or take, but they control the vast majority of the market. So the stock movement is essentially governed by institutions. And then volume as well. So volume, because institutions are using computer programs to buy and sell, and they use these targets that are human mind-generated round number targets. We can predict where they're going to take a stock and where they might drop it to based on support and resistance. And then the volume as well is institutional. So 85% of the volume, give or take, that's a rough number. Let's just say the vast majority of volume is institutional as well. And so this to me allows me to translate this volume into this statement. Let's put up Oracle again, because this was really interesting. This really amplifies the point. Let me pull back up Oracle. Oracle came up on our scanners. And look here, the earnings was announced, and then the stock gapped up and found support at 100. So institutions are not yet prepared to drop it below 100. If they were, we might, and if they decide to, we might see this drop. So they're holding right now, but this is what's important here. When I go to this volume spike day and I drop down to volume, look at the amount of volume there. It's huge. And my scanner found this on Friday. Well, actually, the signal was just today, but I saw it on the radar on Friday, and I was looking at it. But now what I can see here is this. I can translate this massive volume into this statement. That is exceptionally high institutional conviction. Institutions did that mostly. So it's literally like looking over the shoulders of these institutional traders. They're using programs, but we can look over and we can derive their opinions by using support, resistance, and volume. All right, that's trading 101. Now there's other ways to predict, but whatever you do and whatever I do, I'm always looking at volume and support and resistance. You almost don't need to know anything else if you want to predict direction. So, and it's weird. I've been doing this since '98, and I get really excited because this allows me to really see the investor, the big money trading hand. I can see what they're up to, what they think, what they're thinking, and I can and if I know what they're thinking, then I can hop on their coattails and make some money. So that is the power of support and resistance. Let's check our questions here. Sid says, so you said entries and exits a few pennies above and below those numbers. Yes, good idea. One of the systems that I use for stops or entries is I look for maybe a 1% close above resistance or below support, Sid, as a signal to enter. And then I can also use support and resistance levels to give me my price targets as well as my stop losses. So it's really powerful. And every trade I put up, I'm looking at this stuff. And that's why we're not taking Oracle today. Just technically speaking, I'm not interested in this stock until I know that 100 is going to be breached. So Sid, what I'd look for is a close below 100, maybe $1 or $2 below 100, and preferably on some additional volume, so I can see that the institutions may be wanting to drop the stock down a bit. So it's really powerful. Mitchell says, thought they were computerized AI doing those trades. I wouldn't call it artificial intelligence. That term has been used, kind of thrown around as marketing, but they do use computer programs based on rules. And essentially, they have algorithms to detect when to buy and sell and those sorts of things. But from our vantage point, what we want to understand is where are those price targets, and we can figure that out with round numbers. The other side of it is because I know Oracle bounces on round numbers. This is an all-time high here at 106. If the stock broke above 106, then I would say the next target is 110, the next round number. So that we can also get anticipated future resistance levels based on these round numbers. Oracle, Apple. Let's look at Apple, another one. I wasn't planning on talking about this, but it's really powerful. And here's Apple. Same thing. 170 resistance, 175 resistance, 180. The stock here touched 180 and then yesterday fell away with the COVID news. And so when I'm looking at this, there's not enough, unfortunately, the volume wasn't quite high enough for us to go bearish on Apple. But my next target to the downside would be 170. And what's that based on? Well, it's based on a stock breaking below 175, which is support. And then the next level, next round number, confirmed here at 170 would be my price target. Does that make sense, Sid? Volume as well is important. So those are some like tips that I use every single day on every trade I take, and every trade that I published on behalf of Tom have all of this baked in. And so this is the kind of stuff that I want to use this hour to not only talk about the trades that we publish, but also to give you some tools that you can use in every part of your trading. And I talk to a lot of new traders, and this is the first thing that I teach them. It's this, and we can make it better with advanced stuff. But this is powerful, and it's based on real world stuff. It's based on the way human beings are trading. Institutional traders, in other words, we're looking at their humanity, and we're looking over their shoulders essentially. So it's exceptionally powerful. Yeah, Mitchell, good. Yeah, good questions. Yeah, this is, obviously I'm almost foaming at the mouth because it's so freaking great that we have support, resistance, and volume. All right. Let's take a look at, I do this thing risk on, risk off. I do it every week. Let me get rid of these moving averages here. So another really cool way to detect what the markets might be doing is to see where gold might be going next. So I want to detect if money is flowing out of stocks into safer assets like gold. There's others, but gold's the primary one people look at. And that's called risk off. Gold is risk off, stocks risk on. So do we have a risk off move happening right now? If there was, it might skew me towards bearishness, more bearishness in the market. And so what this chart shows, let's get a bit more data, is an inverse relationship between the strength of the US dollar and gold. And what there is always, typically, there's an inverse relationship to the strength of the US dollar to gold. So as the US dollar gets weaker, as it did here, the price of gold tends to rise. As the US dollar gets stronger, as it did here, the black line is the US dollar, then gold gets weaker. And so that inverse relationship is what I'm looking at. And when it's broken, that might, and exclamation point, might be an indication that money is flowing in a risk-off fashion out of stocks into gold. And I'm looking at the relationship, and you can see here, well, first off, here, let me show you what risk-off looks like. Here, the US dollar got stronger, and so did gold. All right, so that was a risk-off move there that happened, and I believe we got a bit of a bearish correction during that time frame. And then the US dollar got stronger, continued to get stronger, and then gold dropped away. So the relationship is now intact. The US dollar has recently gotten stronger and gold weaker. All right, so there's no risk on, risk off. There's no risk off indication based on this chart. Okay, so there's no risk off going on. If there was, I would have a stronger bearish prognosis. All of that said, though, the Fed's meeting as we speak, and tomorrow they speak to us, and the news could very well move the market one way or the other. So even if I did find a trade for today, it would be kind of stupid for me to put it out because there could be a sharp move either way in the market. All right, so that's what we're dealing with. That's the what's so. Mitchell says there's a gentleman who trains Tom's tools. Where can we find those recordings? Yeah, I'm one of those gentlemen. Yeah, depending upon where you got them, I would reach out to Money Map Press and say you want to get access to these recordings. And whatever you have access to, I'm sure they'll point you in the right direction, Mitchell. And then Sid says, gold has not reacted as one would expect with current market conditions. I agree, Sid. For a while, it seemed to be moving in correlation with Bitcoin, but that's stalled as well. As for now, it has. It sure has. Here's Bitcoin. I'm in Thinkorswim simulated platform here. So / BTC is Bitcoin. And you can see Bitcoin, as well as the other cryptocurrencies, are generally under some pressure. A Dogecoin, I think, is up today because Elon Musk, Tesla is going to accept Dogecoin. So I don't have a chart of that right now, but yeah. So the crypto's coming down. The correlation between Bitcoin and gold in the U.S. markets or the world markets there's no solid correlation yet that we've been able to detect. Sometimes it holds in one instrument and not another. So I think for now it's Bitcoin is first crypto in 2009. So we've only got 12 years of history in cryptocurrencies. So the correlations have yet to be set, I guess. Kathy did it again. I don't know if this is a good forum to ask this question, but have you seen any end of year patterns around stocks? Yeah, there are end of year patterns that can happen. There's the thing called the Santa Claus rally that happens sometimes in the stock market. But I would say all bets are off with the current conditions. Inflation, COVID, Omicron. All of that going on is, I wouldn't count on any of those kind of patterns holding for now. But Kathy, if you do a search, a Google search, you'll find that there's a lot of seasonality patterns out there. We have a system called Money Calendar that detects seasonality. We use that. So yeah, that's my answer to that question. Sid doesn't trust Doge. Elon, he says Elon will be tweeting something different tomorrow and crash it. Yeah, exactly. He did that with Bitcoin as well, didn't he? Doge at 18. Eric says replays. Oh, Eric's helped us out there, man. Thank you, Eric. Replays can be found here. He's given us the link. Thanks, Eric. Appreciate it.
No problem.
You are a gentleman and a scholar, my man. Hey, Eric, go yes, Cowboys.
No, stop that.
Eric is a New York Giants fan.
Hey, Eric, tough time to be a Giants fan.
Eric, listen to this, man. The year that the Giants last won the Super Bowl was the year I actually got on the field pre-game, and the Cowboys were playing the Giants in Dallas, and I got to see all the players up close.
Really?
And I saw. It was awesome, man. Those guys are huge, man. Yeah. I saw Eli and everything, and they ended up winning the game and then on to the Super Bowl. So that kind of hurts my heart. Hurt my heart a little bit.
You were part of it.
Still
it's okay.
All right, man. All right, let's get into our trades. Currently, this trade was closed on the diamonds, and we got out on the 8th. So I show risk graphs. When you first look at them, they can be kind of confusing. So let me go back to the entry date. The rationale, I would do this trade all over again. It was a loser. Trading's not called profiting like fishing's not called catching. We will lose on some trades. This happened to be one, and I would do it again. This was a super high probability trade we placed on the diamonds. On the 2nd of December, this risk graph reveals that there's a lot of profit down here. There's profit down here, and there's risk up here. And given the news, I was anticipating that maybe some positive COVID news would come out, but I wouldn't expect it to be solid for a while, and that it was a good move to place this trade. I wouldn't, if there was a retracement, the stock was to rise, we'd have this break even to get us out before we lose a whole lot of money. So we keep our losses capped, and this trade would have made us money sideways, all the way down and up a little bit. And it was a super high probability trade. And then ultimately what happened was the stock, the diamonds, had a strong run based on Mr. Fauci. who I'm a little angry at right now. No, I'm not. All right, so the stock breached the break even. We pulled this off, and we ended up with about a 40% loss on this trade, which is managed. Not a big deal. It's part of trading. That's one of our losses. Let's take a look at our portfolio of open stocks. This is the only one we have open right now. This is on USO. So this is the only open surge trade as I speak. And this trade, let's pull it up. This is what I use to track. This is called a performance report, and I run it against all the open trades that we've done in Surge Strike, and all the closed trades as well, of course. And this is what we're looking at here. We got in on the second. Currently, we're up $46 on this trade. Now, let's see what the risk graph says. First off, this thing expires in 3 days. All right? And let's see what the stock is. By the way, we sold a 52 call and we bought a 57 call. This is called a credit spread. We got 76 cents. This is our third-party tracking company. They're showing a 76-cent credit, offering 18% return on investment in about just under 2 weeks. So that's not a whole lot of return, but the probability of profit was almost 85%. So this is one of those cases where we can trade this crazy market. Let me take you to when we got in on the second. Let's go back in the time machine. I don't know if you don't have Tom's tools. Well, if you do have Tom's tools, I would say there's a lot of power in the tools. One, you can run scans and find trades. I'm going to show you one here in a minute. Secondly, you can get a picture of your trades, and you can anticipate profit and loss in those trades. And then I would say arguably the most powerful feature of the tools is that you can use back testing. I can go back 5-6 years and run our rules-based systems and find trades and actually take them using historic data and build some confidence that the system and the rules actually work. And so all of these tools we have, all of these scanners are all based on that. They work. Historically, they work. So these tools are magic. I couldn't imagine trading without them. I did when I first started trading. But now that I know this, man, it cuts your time in half, gives you a lot of visibility. So we placed this trade on USO, COVID-related crash in oil. This trade initially had an 80% probability of profit. And similar to the other credit spread, it's going to make money if the stock goes sideways. This is all profit here. Stock goes nowhere, we make money over time. Stock drops, we make money. Stock rises and stays below this blue line here at expiration, and we make money. So it's a super high probability way. And in my view, it's really the only sensible way. Well, I don't want to diminish anybody else's opinions, but for me, the best way to trade this market is with these high probability trades that are more immune to sudden moves in the stock, any stocks. So that's when we put it on. Now the stock has recovered a little bit. Let's go to the latest date. So this is the current picture. We're up $46 out of our 76. We've realized 10.8% of almost 18% max profit on this trade. Currently, the spread is worth about 31 cents. I'm just looking at the bid-ask spread here. So that's about what it's going to cost to buy it back. Now the rules that we use are if you've sold this for 76 cents, and that's $76. I realize that's 76 cents times 100 because one option controls 100 shares of stock. So that's our total credit in the trade. Our max risk in the trade is $424. I size everything to a $500 of risk if possible, and this is one of those trades. So the idea here is we're going to put an order in to buy this back for 20% of the initial credit. So that's what, 14, let's just say 15 cents. So that's 15 cents. I want to buy this back for 15 cents based on my original fill. If that happens, if I am able to do that, then I capture 80% of my maximum profit in the trade, which is our credit. So that's the rule. Here's a question for everybody. Are you guys guys and girls, all using these 80% good till cancel profit stops that I publish each time we put up a trade? Are you using those things? There's some questions while you're answering that. Okay, so Kathy says there's no. Tom has Kathy. Tom has the suite of tools that are app based, and those are free. Yeah, so those are free, and then this software actually has a subscription level. And I would reach out to Money Map Press if you're interested in exploring these tools. And there's a lot of education. There's a lot of videos that come with them that to help you learn them. So they're really, really great stuff. And then Andy says there's 3 subscription levels. That's what I believe is the right price there, Andy. But again, reach out to Money Map Press and they'll set you up. Okay, I haven't put up a trade from OSS yet. Okay, Kathy has not. I don't know what OSS is. Sometimes, okay, I don't see any real questions. All right, so, some people are answering. Yes. All right, Tom, K Rit, yes. And then Kathy, not yet with OSS. Sometimes, yes. CC limits for okay, yeah. So here's how you do it. I'm going to do it in Thinkorswim in a simulated environment. I'm not recommending Thinkorswim. I'm not taking these trades. I'm not allowed to. I never would. I'd get in big trouble if I did. But let's pull up the USO. And so basically, we want the USO to stay below. This is a chart within Thinkorswim. As long as the stock stays below 52.50, this trade is going to give us max profit by Friday. So, and the USO could just as easily be above 52.50 on Thursday. So the thing that we do, let's go back to the original trade. So what I want to do, and it's really a good idea for you to do, is once you're filled on the original order, to put in immediately after the fill, put in the opposite order to buy the spread back for 20% of what you originally sold it for. When that executes, you'll have 80% of your maximum profit. And that will, once you're out of the trade, you don't have to worry about USO gapping up with a positive piece of news from the Fed. So that's what we want to do. So here's what we got into the trade by selling the December 17 52 call. That's Friday, by the way. And we bought the 57 call above. All right, and we did that for a credit. A limit of, I think I had it at 75 cents. We got filled at, the third party got filled at 76 cents. So that was the originating order. And then you get a position, and you have a position in this. Let me show you what it looks like in Thinkorswim. I track these trades in Thinkorswim. If you go to activity and positions under monitor, and let's go find USO, there it is. I may have other positions in here. I have a couple. All right. So this is the one. We've sold the 52 call, and we've bought the 57 call. So that's the position that I'm referring to. And what I wanted to, so we sold the 52, we bought the 57. So to do the inverse, of course, what you want to do is buy back the 52 and sell the 57, which is precisely the opposite of what we did to get in. So from my position within Thinkorswim, I can highlight both of those legs of this order. I apologize for these two. That's another trade I was playing with. And I'm going to go ahead and right click. Let me back up. So you highlight the position legs, click, and then control click, and then you right click and create a closing order. There it is. All right, so currently I could buy this back for 43 cents mid-price. I sold it for 76. I'd net 35 cents roughly, 34 cents. I could do that right now, but the rules say get out at an 80% or 20% of maximum credit or the originating credit. So that would be 15 cents. And then I would make this a good till cancel. All right, so now I'll review this in a form-based platform like Schwab in a minute. But let me do it now. In Schwab, what you would do, or form-based platform, any form-based platform, is you would set up the order like this. Buy one of the USO, December 17, 52 calls, and then sell one of the December 17, 57 calls for a limit debit of 15 cents. Good till cancel. So this is the same as it would look like in a form-based platform. and then you click confirm and send, verify that you have the right order, and then you click send. And then when you go back to monitor and you go to working orders, you can see right here on the top, there's my order to buy it back for 15 cents. Currently it's worth 42. We go back to the risk graph. You know, this trade's in pretty good shape. There's strong resistance right at 52. All right. If the stock goes sideways between now and Friday, we're going to make max profit. We'll hit our profit target anywhere below 52 between now and Friday, because time's working for us. There's a Greek called theta, if you want to talk theta. We're making $8.78 a day based on the current price of the stock. So theta, time decay, is working for us. Probability of profit is still pretty high. Let's see what it is. It's 85%, almost 85% probability of profit. So this trade is looking good. So how do we get out of this thing? Well, we got our profit stop, and then I'm going to keep my eye on this break even, and I'll tell you when to get out for a loss. Currently, at the break even, the most we could expect to lose is $42 on this 410%. So right there, our max risk in the trade is 424. And right there, today at the break even, if that happened, I would lose $42. So that's 10%. So we're managing our risk really well with these credit spreads. So stay tuned for alerts. Use the GTC if you haven't already. And that's how we manage these. All right, Tom says, oh, Jay Harris, of course. OSS equals Operation Surge Strike. Thank you. I got some, you should see inside my brain what's going on right now. It's all over the map. And then Tom says, I closed USO earlier for a nice gain, but I was still holding it. I would be tempted to sell now. What's the risk gain holding it until expiration? Well, right now you would get about 40 cents for it, 43 cents. And, you know, that's a quick, you would I would not do that. But if you're really convicted that the USO is going to stay below 52, then that would be a reasonable trade to do, Tom. But I'm not recommending it. I'm not giving financial advice. But if your prognosis is that USO will be below 52 between now and Friday at 4 p.m., and you're willing to step up, that could be a good trade. I'll build it for you real quick using the tools. I'm going to go into option chains, and I want to use December 17 options, and I'm going to go ahead and do the 52, sell the 52, buy the 51. This is not a recommendation. this is educational, everybody. I'm not saying go out and do this. It's risky. But currently on that spread, the software is saying you could get 11%. 11. Well, this is a 50-cent strike. So this is a really tight credit spread offering 28% over the next 3 days. All right. Taking 11 cents, risk $39. If I did what? Let's say 40, 20, 15 maybe? That's probably too high. I think that's going to be 600. Let's see what we got here. So I want to keep my risk below 500. Let's see, 42 of those. Let's do 13. That should get me right at about $500 of risk. So Tom, what you're saying, this is what you've asked me, and this is the answer to your question. You could do this trade here, a 50-cent credit spread, sell the 52, buy the 52.50, a 3-day trade offering 28%, and the probability of profit is 75%. Okay, so those, if you are convicted that 52 will hold, then based on that prognosis, this would be a trade that would match up to that prognosis. So that's the power of these credit spreads. I might actually take a look at this one later. I know Jay's on the call. We have another call coming up at 3 o'clock. So we might look at this one, but I would not publish this trade. It's not based on any of the surge strike rules. And it just, it's not a recommendation. I want to be really clear. I'm just answering a question for educational purposes. Merrill says, should one change strategies in this high volatility and trade longer term? Yeah, there's some really cool stuff we can do with long-term options, Merrill. Again, based on prognosis, you can construct a trade to fit any prognosis. If you were expecting the markets to set new highs in 2022, you could put on a trade for that. If you're expecting the market is going to pull back between now and the end of next year, you could put a long-term trade on to accommodate that as well. So I think that's reasonable if you have a long-term prognosis. I've been bearish. I've been bearish since COVID happened and we got a bounce, and I've just been waiting for there to be another big correction, and it hasn't happened. Will it? I don't know. No, but I don't know the future. I don't know the future. I can only guess. So good question. All right, let's take another look at. I'm going to run a quick scan here, and I want to show you how we're doing in our portfolio in Q4. So I'm going to run this report here. I've only got 4 minutes left. These are the live trade recent closed trades. I'm going to go back to September the 1st, and we're going to run this report. And this is how we've done over the last quarter, this Q4. Oh, I'm sorry, that starts 10, excuse me. That doesn't matter. All the trades in here are just started in October. So these are all the trades we've got. We're making money. 67% of our trades are winners. Our average profit per trade is $67. Okay, so I showed you this last week. Our average profit per trade, change that to 67. What does that mean? And the average trade length is also just 8 days. So we're making about $67 every time you place a trade. This is an average of the winners and the losers. It's position sized. So we're making 11% every time we put on a trade in about 8 days. So remember, you might not think that's very good, but that's every 8 days. Let's assume that's every month. If you take that 11% and you compound that, meaning you take your profits and increase your position size as you make money, that's a triple. Your 5,000 becomes 17,000 if you're making 11% a month. So this is really important. It's sort of inauthentic to think that trading is about hitting home runs and winning. Trading is really about having a system that mitigates losses. Embedded in the system is loss mitigation, because we can't stop from losing. It's part of this game. You must experience losing, and you've got to have systems and rules that allow you to navigate that very emotional experience of losing money. I still have the emotions. When I lose money on a trade, it doesn't feel good. It doesn't. And in the heat of the moment, when I'm losing on a trade, guess what my first thought is? Well, maybe tomorrow it'll drop back where I need it to drop, or go up to where I need it to go. Let me find some news. Let me find a reason to stay in. You'll find a reason. There's plenty of them. But your salvation as a trader, if you really want to make money in trading, is to follow rules. It's that simple. Now, there's probably traders that don't have rules. I doubt it. Not successful ones. And the major point I'm making here is you don't need to make a lot of money every month. 10% a month is massive. That's tripling your money in a year almost. And this chart is only showing you, average trade 8 days. You're in and out in 8 days. We could even triple the number of periods. If you're getting in and out every week or so, you're doing 3 trades a month. Then now you're looking at 36 periods, 36, and then the return is just off the freaking charts. It's just mind-blowing. And so I'm excited. I want you to be excited, because if you're doing, and we are doing 11% a month, hard closed trades, that's what we've been doing. And if it continues, and it's likely to, then over the next 2020, you're all going to be very, very happy that you've been part of Operation Surge Strike. All right, now I've got a trade on Nike that I'll cover later in the week. I'm at the top of my hour. I could talk for hours and hours, but I'm not. I'm going to let Eric go on to the next thing. Thanks, everybody. See you next week. Have a great rest of your week, an awesome weekend, and we'll get together next Tuesday at 1 p.m. Eastern Standard Time. Bye, y'all.